Welcome to CrushTheStreet.com's weekly market wrap-up. We hope that you enjoyed your Good Friday holiday and had time to reflect on the important people in your lives. Looking back at the markets, it was a holiday-shortened week, although it ended with tremendous optimism with the Dow Jones and the S&P 500 both closing at record highs. Is this enough evidence to confirm the re-emergence of the American bull market and therefore silence the rapid gold and silver bugs? On the cursory level, one would be forgiven in returning back to US equities. After all, we are seeing nominal improvements in several sectors, including real estate and manufacturing. And while arguments can be found suggesting that these economic numbers are phony baloney, at some point we have to accept the data for what it's telling us, an improvement in the economy. For now. Along with a stronger economy is a stronger currency. While it's comforting to say that precious metals, due to their intrinsic value, is in a constant 24/7 bull market, the truth of the matter is that every financial asset runs into cycles, and gold and silver are no exceptions. In fact, many experts in the resource and commodities industry are hurting deeply right now due to the deflationary cycle created by an ever-rising US dollar. However which way you want to look at it, the greenback has wings. How else would you explain a 5% rise in valuation in 2 months' time? And it's very possible that the dollar could go higher from here, given its competition in the global currency war, one that it's surely destined to lose. So does that mean that every financial expert who was so confident and bullish towards the precious metals sector was painfully, irrefutably wrong? Not at all. First off, we have to understand that the United States, although it is the biggest and the baddest, no longer dictates terms for everyone. There are other international factors to consider, and there are countries, namely Japan and South Africa, where gold and silver have been on a constant bull market. In fact, Bill Murphy of GATA would be out of a job very quickly if he were in Japan, since gold is moving upward according to everyone's expectations. But the most important point to consider is the difference between balance sheet inflation and street inflation. Balance sheet inflation is what the Federal Reserve has been doing all these years with their quantitative easing programs. They buy whatever-backed securities, but those securities have to go somewhere. If they were dumped onto the open market, you will see street inflation. Loaves of bread at $20 and a gallon of gas for $50. Of course, the Fed doesn't want street inflation, so they put these assets into their books. Since the start of QE, the Fed's balance sheet ballooned from $900 billion to over $3 trillion, and at some point, this extra liquidity has to be addressed. The sensible option is to raise reserve rates to 15 to 20% in order to prevent a mass exodus of liquidity into the open market, but this of course would be deflationary to the markets. However, central bankers are rarely sensible, so a deflationary shock could incentivize the Fed to experiment with further loosening. At that point, the excess liquidity may not be able to be hidden in the books, and we could see significant inflation or really hyperinflation hit the streets. That's why it would be absolutely foolish to completely rid yourself of any exposure to precious metals. What many Americans don't realize is that the Fed is running low on the ability to keep liquidity on their side of the ledger. Further experimentation with the monetary supply could in fact have very serious consequences, and you do not want to be left holding the bag. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.